There's a type of retiree that almost nobody notices. You've probably seen this person. Maybe in a grocery store parking lot or sitting alone in a cafe on a Tuesday morning. He drives a simple car. He doesn't look wealthy. He doesn't talk about investments. But here's the interesting part. Very often, that retiree has more financial security than people who appear far richer. I discovered this a few years ago when I started noticing something strange in the behavior of certain investors who had around $500K or more in retirement savings. Some of them seemed stuck at that level for years. Others, without doing anything that looked extraordinary, watched their portfolios grow to $700K, $900K, sometimes $1 million or more. Same markets, same types of investments, same economy, but completely different outcomes. And after speaking with many of these retirees, people who truly understood how to retire with peace of mind, I began to notice a quiet pattern. It wasn't about picking better stocks. It wasn't just about avoiding 401k mistakes. And interestingly, it wasn't about working longer either. It was something much simpler. A habit that is almost invisible. A behavior so common that most people completely overlook it. Later in this video, I'm going to show you exactly what that habit is, something that separates retirees who reach real financial freedom from those who spend years protecting the same $500K without ever moving forward. And when you realize what it is, you'll probably think, how did I never notice this before? But before we get there, we need to understand why $500K is one of the most dangerous moments in the entire process of retirement planning. Because it's exactly at this point that many people begin making the mistakes that quietly stall the growth of their portfolio. You know, I've spoken with many people who spent 30 or 40 years working hard, contributing to their 401k, and doing their retirement planning with discipline, and when their statement finally shows $500,000 invested, something curious happens. They lean back in their chair, take a deep breath, and think, all right, now I'm safe. It's understandable. $500,000 feels enormous when you remember that very first deposit years ago. But here's the thing. That feeling of I made it is exactly where many retirement mistakes begin. Let me describe a scene I've seen several times. A couple reaches retirement with around $500K in retirement savings and believes they've finally achieved financial freedom. But when they start running the numbers, factoring in Social Security, healthcare costs, and inflation, they realize that number isn't really a finish line. In reality, it's more like reaching the middle of a mountain trail. Beautiful, yes, but there's still a climb ahead. Now, here's a detail that rarely comes up in conversations about investing for retirement. If you apply the well-known 4% rule, that $500,000 portfolio might generate roughly $20,000 per year. Break that down month by month, and you're looking at something around $1,600 to $1,700 before taxes. Suddenly, that number that once felt gigantic starts to look a lot more modest. And that's the moment when many people begin to rethink how the process of how to retire comfortably really works. And this is where a quiet difference appears between people who simply accumulate money and those who truly build security for retirement. Some look at $500K and slow down. Others do the opposite. They start observing their portfolio with more curiosity, almost like a gardener watching a tree that has finally begun to bear fruit. And that naturally leads to a far more interesting question. A question that completely changes how we think about retirement planning. When someone first starts investing, the conversation almost always revolves around a single number, the account balance. How much is in the 401k? How much has been accumulated in retirement savings? How far they are from the next milestone. It's almost like watching the scoreboard in a game. And of course, that's part of the process of investing for retirement. In the beginning, every increase in the balance brings that satisfying sense of progress. But there comes a point, usually around $500K, when more experienced investors begin to look at that number in a different way. Instead of asking, how much money do I have, they start asking something far more interesting. How much income can this money produce? It may sound like a small shift, almost insignificant, but believe me, it completely changes how we think about retirement planning. I've seen two friends sitting side by side, both with almost identical portfolios. One of them saw only a number on the screen. The other saw something more like a small income engine quietly working in the background. That second type of person starts observing their portfolio differently, not just balance but cash flow, not just growth but efficiency. For example, some begin combining broad ETFs like VTI or the S&P 500 with assets that generate income, such as dividends from stable companies. Think of established businesses that have paid dividends for decades. Suddenly, investing for retirement stops being just about accumulation and becomes about organizing a machine that can support a lifestyle without depending entirely on work. Interestingly, this shift in mindset also helps people avoid many common retirement mistakes. When the focus turns towards sustainable income alongside Social Security in the future, decisions become more strategic. It's no longer about trying to pick the next big investment. It's about creating stability over time. And it's precisely at that moment that many people begin to notice something interesting. The stretch between $500K and $1 million may be one of the most delicate phases of the entire financial journey. There's an interesting moment in the journey of someone investing for retirement. It doesn't happen at the beginning when the balance is still small and every contribution seems to make a big difference. And it usually doesn't happen once someone has already crossed the $1 million mark. This moment tends to appear right around $500K. It's like reaching the halfway point in a marathon. You've already covered a good distance, but you still need the energy to keep going. And interestingly, this is exactly where many people begin to slow down. I've heard this sentence countless times. Now the market will do the rest. And honestly, it's a very seductive idea. After years of avoiding 401k mistakes, contributing consistently, and learning about investing for retirement, it seems logical to believe the hard work is already done. But the reality is a little more subtle. The stretch between $500K and $1 million often requires more mental discipline than any earlier phase of the financial journey. The reason is simple. Once a portfolio reaches this size, small decisions begin to have enormous consequences for the future. Stopping contributions too early, for example, can slow growth more than people realize. Making the portfolio overly conservative out of fear of a market decline can also reduce long-term growth potential. These are silent retirement mistakes. They don't feel like errors when they're made, but their effects appear years later. But here's the interesting side of this phase. When someone continues contributing, maintains a balanced strategy, and avoids reacting emotionally to market fluctuations, something powerful begins to happen. Compound interest, which once seemed slow, finally starts to gain momentum. It's like pushing a ball uphill for a long time and suddenly realizing it has begun rolling almost on its own. And it's exactly at this point in the story that a decision appears, one that many retirees eventually make, and that can completely change the final outcome of their portfolio. I want to try a quick experiment with you for a second. If you've already realized that most people learn about retirement planning too late, if you've ever seen someone make retirement mistakes that could have been avoided, then do something right now. Leave a like on this video. Not for me, but so the algorithm can show this video to other people who are trying to understand how to retire with more peace of mind before they repeat the same mistakes. And if you enjoy this kind of conversation about investing for retirement, the kind of honest discussions that usually don't appear on traditional finance channels, then consider subscribing. Because every week, we explore exactly this. The quiet decisions that determine whether someone reaches financial freedom or spends their entire retirement trying to protect what they built. Now, let me show you something interesting about the $500K retirement savings milestone that very few people notice. One of the most interesting things I notice when someone reaches $500K in retirement savings is a quiet change in behavior. For decades, the person was disciplined. They contributed every month, avoided many 401k mistakes, studied retirement tips, and handled their retirement planning carefully. But when the portfolio reaches $500,000, something shifts. Many people begin reducing their contributions. Not because they've become careless, but because they feel they've finally earned the right to slow down. And honestly, that feeling is completely human. After so many years of working, the idea of easing off the accelerator a little seems fair. Some people even think, maybe now I can invest less and enjoy life more. The problem is that this decision often happens at the exact moment when contributions start working together with portfolio growth instead of carrying the whole load alone. It's like planting trees for years and then stopping the watering right when they begin to produce shade. I like to use a simple example here. Imagine two people who both have $500K invested. One of them decides to stop contributing to the portfolio. The other continues adding about $1,000 per month, which is fairly common for someone in the final years of their career. 10 years later, the difference between those two paths can easily reach hundreds of thousands of dollars. Not because the second person was brilliant at investing, but because they kept doing something simple. Consistency. This is one of those quiet details that makes an enormous difference in the long-term process of investing for retirement. And interestingly, many retirees who reach true financial freedom understand this almost intuitively. They don't try to make dramatic moves in the market. They simply keep feeding the system that's already working. But there's another behavior that tends to appear at this stage, something driven by fear, and it can impact the portfolio just as much as stopping contributions. There's an interesting moment when a portfolio begins to grow and approaches numbers like $500K in retirement savings. Up until that point, many people were comfortable with a certain level of market exposure. After all, they were thinking long-term, investing in broad ETFs, index funds, maybe a few established companies. But when the number in the account starts to look truly large, something changes. Fear appears. The question comes almost automatically, what if the market drops now? And to be fair, that concern isn't irrational. After decades of building your retirement planning, nobody enjoys the idea of watching the balance decline. So many people do something that seems logical. They begin moving a large portion of the portfolio into extremely conservative assets, bonds, idle cash, investments with almost no risk. At first glance, it looks prudent after all. Who wants to make retirement mistakes at this stage of life? But experienced retirees know there's an important difference between eliminating risk and managing risk. If a portfolio stops growing too early, it can quietly lose the race against inflation. And inflation, as you know, doesn't ask permission. It simply erodes purchasing power year after year. That's why many experts in investing for retirement still keep a portion of their portfolios in growth assets even during retirement. I'm not talking about betting on speculative companies or trying to predict the next big investment. Usually, we're talking about something much simpler, broad funds like the S&P 500, diversified ETFs, or shares of mature companies that pay consistent dividends. The goal is balance. Enough stability to sleep well at night, and enough growth to keep the money working. And when the portfolio begins to move beyond this point, a new question starts to appear, one that very few retirees consider during the early stages of planning. Something interesting happens when a portfolio begins to grow and approaches or passes $500K in retirement savings. For many years, the focus was on a single mission: contribute, invest, avoid 401K mistakes, and watch the account grow. But suddenly, a new variable quietly enters the game: taxes. And what's curious is that many people spend decades learning how to invest, but almost no one learns early on how to withdraw the money. During the process of investing for retirement, most conversations revolve around where to invest. ETFs, index funds, individual stocks, maybe some fixed income. But when the time comes to turn that wealth into real income, especially when combined with Social Security, the question changes completely. It's no longer just, how much do I have, but where should I withdraw from first? And that small decision can significantly affect the final outcome. Imagine two retirees with exactly the same $500K portfolio. One begins withdrawing money directly from the 401K each year without much strategy. The other organizes withdrawals more carefully, perhaps using taxable accounts first, then tax-deferred accounts, coordinating everything with Social Security benefits. Interestingly, over 15 or 20 years, the difference in taxes paid can easily reach tens of thousands of dollars, not because of different investments, but because of withdrawal strategy. That's why many experts in retirement planning say something that surprises people. The withdrawal phase can actually be more complex than the accumulation phase. It doesn't require anything extravagant, of course. Sometimes it simply means organizing the flow carefully or speaking with a good financial planner. But the most interesting part is this. Even with smart tax planning, there is another risk in retirement that's even more common, and it almost never appears in books about investing for retirement. There's a quiet temptation that often appears when someone finally reaches something like $500K in retirement savings. For years, the person was disciplined. They avoided retirement mistakes, contributed consistently to their 401 CAC, and patiently watched their portfolio grow. But when that number finally shows up in the account, a thought almost inevitably appears. Maybe now I can relax a little. Maybe it's time to enjoy things more. And of course, enjoying life is part of any good retirement planning strategy. The problem is rarely spending a little more. The real danger appears when small lifestyle upgrades turn into permanent expenses. A slightly nicer car, a slightly bigger home, more subscriptions, more trips planned every year. None of these decisions seems excessive on its own. But together they create something few people notice: growing pressure on the portfolio. I've seen this happen many times. Someone approaches retirement believing their investments, combined with Social Security, will comfortably support a certain lifestyle. But after a few upgrades in spending habits, that same portfolio suddenly has to support something larger. It's as if the entire system now has to work harder just to keep up with the new pace. And that can create several challenges during the process of figuring out how to retire comfortably. More experienced retirees tend to do something interesting at this stage. They treat the portfolio as if it were a tree that's still growing. Instead of cutting too many branches too early, they allow the tree to gain strength. They keep investing, maintain discipline, and avoid sudden lifestyle changes. Not because they are overly cautious, but because they understand that there is a specific window of time after this milestone that can completely shape their financial future. Let me ask you a quick question and be completely honest. When you think about retirement, what number feels safe to you? $500K? $1 million? Or do you not focus on numbers at all and prefer to rely more on Social Security and monthly income? Write it in the comments. Because one of the most interesting things I've learned from talking with people who actually manage to retire early or live comfortably after their careers is that everyone has a different definition of financial security. And I always enjoy reading those answers because sometimes a simple comment reveals more real retirement tips than many books. So tell me down below. And while you're thinking about that, there's a curious detail about what happens right after a portfolio passes $500K that almost nobody talks about. There's a very interesting phase that begins right after someone reaches something close to $500K in retirement savings. I like to call this period the 10-year window. It's not a rigid rule, of course, but it's a stretch of time when two forces start acting at the same time: the growth of capital and the impact of the decisions you make. It's a bit like caring for a tree that has finally developed strong roots. Now, the way you care for it determines how large it can grow. During these years, compound interest begins to work in a much more visible way. At the beginning of the investing for retirement journey, compounding often feels slow, almost timid. Many people spend years contributing to their 401k and feel like progress is always crawling forward. But once the portfolio reaches something like $500,000, even small percentage gains begin to produce much larger numbers, and that changes the dynamics of the game. Imagine two simple scenarios. A $500K portfolio growing at an average of 5% per year might reach close to $800K in a decade. But if that same portfolio grows at 7% or 8%, which isn't unusual in well-diversified investing for retirement portfolios, it can easily surpass $1 million. The difference may look small when expressed as a percentage, but over 10 years, it creates a massive gap between two financial futures. That's exactly why experienced retirees tend to become especially disciplined during this stage. They understand that avoiding retirement mistakes now is more important than trying to find the perfect investment. They keep the plan simple, continue contributing when possible, and allow time to work in their favor. Interestingly, when you observe people who actually achieve financial freedom during retirement, there is almost always one quiet habit that appears again and again. Something simple, almost boring, but incredibly powerful. When you observe retirees who have truly built financial stability, the ones who seem to move through the decades with calm confidence, you start to notice something interesting. They don't make dramatic moves. They're not constantly trying to predict the next move in the market. And surprisingly, they're rarely talking about the investment of the moment. Most of them simply follow a set of quiet habits within their retirement planning. Many of these people learned often after making a few 401k mistakes early in their journey that consistency matters more than brilliance. Instead of trying to perfectly time when to buy or sell, they maintain simple strategies for investing for retirement. Many rely on broad ETFs, such as funds that track the S&P 500 or the total market, and they review their portfolio from time to time. Not every day, but perhaps a few times a year, calmly and deliberately. It's almost interesting to watch. While some people become absorbed in financial news and daily market swings, these retirees do something far less exciting. They continue contributing when possible, adjust the portfolio carefully when needed, and allow time to do most of the work. This kind of simple discipline helps avoid many retirement mistakes and gradually create something extremely powerful over the years: financial momentum. And momentum, in the world of personal finance, is a bit like pushing a bicycle. At the beginning, it takes effort, but once the bike gains speed, keeping it moving requires far less energy. That's exactly why when someone protects that momentum after reaching something like $500K in retirement savings, they often begin to notice something fascinating: growth that almost feels automatic over time. Many people see the financial journey as a sequence of magic numbers. First $100K, then $500K, then $1 million. It's almost like marking checkpoints along a long road trip. And of course, those milestones have their value. They show progress and help measure advancement in retirement planning. But over time, people who truly understand the process of investing for retirement begin to notice something interesting. The number itself isn't the real goal. The real goal is maintaining momentum. Think of your portfolio like a large wheel that you spent years pushing. In the early years, it was difficult. Every contribution felt small, every bit of growth seemed slow. You probably avoided several retirement mistakes, adjusted your strategy a few times, and learned along the way. But when that wheel finally starts turning with real force, usually around $500K in retirement savings, the game changes completely. At this stage, something fascinating begins to happen. Growth starts coming not only from contributions, but also from the portfolio itself doing the work. A 7% return on $50,000 is one thing. On $500,000, it's something entirely different. And when that growth combines with smart decisions, controlled spending, planning around Social Security, and long-term discipline, the feeling of financial freedom begins to appear much more clearly. That's why many experienced retirees say the real secret isn't just learning how to retire, but learning how to keep the system running once it starts producing results. When someone protects that momentum, growth can become surprisingly natural. $500K turns into $700K, then $900K, and often crosses $1 million much faster than those early investing years. And interestingly, when people finally reach that point, they often realize something that almost no one expects at the beginning of the journey.